Let's talk about the precious metals. It's been volatile, Phil. We got gold here. We're back above 5,000. So dip buyers, they stepped in here, Phil. What do you see ahead for gold near to intermediate term, Phil? What are the levels you're watching?
I mean, we see a scenario where gold hits 6,000 in 2026. It's really driven by that continued central bank buying, the private investor ETF flows, the Fed easing with that first interest rate cut, most likely in June. We saw a setup here today where it looked like should move higher based upon cross asset patterns. What people want to really look at is a dollar index, which provided the fuel to reignite the rally. So currently gold has an 80% inverse correlation to a dollar index, which posted a big lower high on the charts. And then you saw treasuries and a dollar. They both fell as the Chinese regulators urged banks to reduce that US debt holdings. So we saw 10-year treasury yields come off. And it was that combination of weaker dollar, weaker treasury yields, big boost to the gold market.
So let's say, Phil, we're talking. And I say, Phil, I got stocks in the portfolio. I got bonds. I don't own gold. Should I be buying here, Phil? Should I be buying at 5,100? Or maybe there's going to be a better entry point here in 2026. What would you tell me?
Well, I would say that, you want to allocate. I mean, the 60-40 portfolio is just really dead here at the moment. You need to incorporate small slices in your portfolio of key commodities, things like not only gold, silver, copper, crude oil, at some point, Bitcoin, allocating some of that, because you'll have more portfolio diversification, and it's going to benefit you and help you against geopolitical risks and also inflation. So we are seeing quite a bit of widespread adoption with those portfolio flows into it. So I would say that an investor hold no more than 10% of their net worth in the gold market, but really just starting off with some kind of allocation, like a 1% to 2%, makes complete sense.
Phil, I don't know if you saw this one over the week. Bloomberg was reporting data over the weekend showed the Chinese central bank extended gold purchases, Phil, for a 15th month. Do you expect that trend to continue, Phil? And when you read that, I mean, how important is that as a tailwind for the kind of bull run and bullion that we're talking about?
Yeah, the central banks widespread are diversifying away from the US dollar, other currencies, and they're all increasing their gold reserves. On average, the holdings are about 20%. China only has like about 8% of their reserves in gold, and the goal is really to bring it up to like 30% across a lot of emerging market central banks. So if you look at like India, for instance, their holding of US treasuries has fallen to a 5-year low. And what are they doing? They're adding gold, they're adding other alternatives and taking this. It's just this broader shift by some of the major economies to incorporate gold into their FX holdings because of the fact under Basel III reform, it's a tier 1 asset. So it's as good as cash or as good as US treasuries.
In addition to the metal, Phil, give me your take on the gold miners. What do you see?
Well, the miners, they're all doing well. I mean, they have their own challenges because of the fact that they're companies. I always tell people, if you want to buy gold, why not just buy gold? Buy the futures or buy an ETF that tracks it, because of the fact that's what most people are going for. Now, I do understand that people look at leverage and things like that when they're buying these miners. They look at it as long-term call options that don't expire on the markets. But you really got to be careful when you're picking miners because of the fact it may be listed as a gold or a silver miner. But the reality is that there's a number of other metals that they are producing out there. You've also got to look at their debt. You got to look at inflation. If fuel costs start to go up, if interest rates start to trickle up again, that's where those really have some problems.
So we talk gold, Phil. I do want your take on silver because it's been making some wild moves. What do you see ahead there for silver near intermediate term?
You look at the silver, the 10-day average true range, $12.50. That critical support's like $70. Resistance, we're right up against this resistance that we saw before, and we could really open up the door for a move back into the 90s. I mean, they've got a multi-year supply deficit. They've got booming industrial demand. You've got the AI, the EVs, the solar. But one thing that people have to know is that it's important to know that half of the global silver demand is really driven by industrial use, and those higher prices could have long-term negative effects on demand. So high elevated costs make like components in solar panels just less economical. So you have this substitution risk that occurs. So when these prices go vertical, it's really important to have a strategy and an exit strategy. I mean, you're going to reduce your demand for silver or for jewelry, for silverware. And if you look at the ETF flows, they have not eclipsed those 2025 levels. So there are a lot of things out there to just be aware of. I'm not bearish on silver, but you have to look at both sides of everything.
Phil, we got some important economic data this week, right? We got jobs report, got inflation data. One, what do you expect to hear there, Phil? And two, what could that all mean for the precious metals we're talking about?
It seemed like some of the officials were really shooting out some warning signs that this number could come in low. I mean, the consensus is like right around 69,000, but I'm seeing independent forecasts that are just south of 50,000. That could help push down those yields and then also boost up the gold and really put some pressure on the dollar. We will have that inflation data, and you are seeing a bit of elevation in some of the energy sector, but I don't think it's enough to really push things up and have any kind of widespread caution out there in the market.
Finally, Phil, because I'm curious, I don't think I've heard it yet. Trump's pick. Trump said, you know who I want run the Fed? Kevin Warsh. That's my guy. I'm just curious, Phil, you heard that. What did you think? You like that pick?
I know. When they announced it, you saw the price action in the markets, that they were really coming out that he was hawkish. He's against, quantitative easing and things like that. But I think that the reality is that the models that they're incorporating will be able to better time and better make some adjustments to monetary policy than some of the things that Jerome Powell is using. And I think that's that kind of shift of having some new elements in there, working closely with Scott Bassett. I think that they could really get the job done, and we'll see much more aggressive interest rate cuts.